So, it's been a pretty big item to have missed since the new year. Coronavirus, or COVID-19, has been at the centre of the world's attention for the last 8 weeks. The risk of a pandemic has been declared by multiple organisations around the world, and there has been some pretty drastic action taken in some cases. But how has coronavirus had an impact on the world other than people's health, and why? Well, one of the biggest areas affected other than health is the global economy. We have seen stock markets around the world record big losses in the last 2 weeks. One statistic shows that $5 trillion of value has been wiped out of the global financial markets. But why is this? And how can a virus cause such a dramatic financial impact? Well, we have to start with how interconnected the world, and particularly the world economy, is. These days, events around the world can have big impacts on other areas, even if they are thousands of miles apart. This is exactly what we started to see when coronavirus was first announced in the Wuhan province of China back in January. After the Chinese realised the seriousness of the issue, they locked down large parts of the country, meaning people were sent home from work and life as normal in China stopped. This started to have bigger consequences on the rest of the world due to how big a player China is today in the world economy. Not only are they a massive producer of items we use every day, from iPhones to your Nike trainers, they are also a huge customer base for many international companies. Car sales alone in China were down 92% in January 2020 compared to January 2019. So, because China is one of the main manufacturing centres of the world, and they stopped manufacturing, this has had huge knock-on effects. We first started to see it with the cost of oil dropping considerably, which is actually quite beneficial to most people who use cars, as you will have seen the cost of fuel decrease. But this was an early sign that this event was going to have bigger impacts. As mentioned before, there are many international companies that use China to produce their products. Let's use the tech giants, and in particular Apple, as an example. Apple use a company in Asia called Foxconn to make the iPhone. Due to the coronavirus, the factories used to make the products like these have had to close temporarily or partially, which has meant production of these items has reduced drastically. This leads to less products being produced, and therefore less can be sold around the world. This in turn leads to less sales, turning into less profit. That is why we are seeing many companies issuing profit warnings about the year ahead. There are also companies that might not wholly produce their products in China, but rely on parts for the products that are made in China and then shipped to another part of the world for putting all together. Car manufacturing is a good example of this, and these supply chains rely on what is called just-in-time logistics. This essentially means that the parts needed to make a product arrive just in time rather than sit on shelves in warehouses where they are not making money. Because there is such a tight operation in place, if there is one delay in the production process, this can lead to big delays further down the line. Again, the bottom line is that this can reduce sales and therefore reduce a company's profit. With coronavirus now spreading outside of China, another industry we are starting to see being affected is the airline industry. People have become considerably concerned about travelling, and some governments are issuing advice not to travel to certain areas. This inevitably means people will travel less, and the mode of transport that is used to travel from country to country the most is air travel. We have seen the owner of British Airways, IAG, issue warnings, along with many other airlines, with some warning of job losses. So where does that leave you if you're an investor? Well, it all depends on what assets you have invested in and what your long-term plan is. Starting with the stock market, we have seen large reductions in stock market value across the board in the last 2 weeks. If you have assets in the stock market, they are most likely of less value than they were at the end of last year. That is not a reason to panic and try and take your money out. Provided that you are a long-term investor and don't need your money straight away, you will see the stock market rebound and return to higher levels than we are seeing now. From a new investor or anyone looking to invest now, arguably you are in a good position. As an investor in the stock market, your basic goal is to buy stocks when they are cheap and sell when they gain value. Well, with the mass sell-off we have seen over the last couple of weeks, you are able to buy stocks at a much cheaper rate than you could at the beginning of the year. This could actually be a good time to invest in the stock market, provided you're happy to leave your money there for the very least 12 months, ideally longer. So why has there been a mass sell-off? Well, in simple terms, investors have become concerned about the impact coronavirus is having on the world economy. As we spoke about before, if a company isn't able to sell as much, then they can't make as much profit, which leads to them being seen as less valuable, and therefore people will sell their shares in those companies. If you're not happy about leaving your stocks to recover and want to change your investment portfolio, there are a number of options. With the sell-off of shares, investors have been moving their money into government bonds, which are essentially loans that governments take out to pay for things like public services. The prices of these have increased over the past 10 days, and yields, which is used as a measure of your return on investment for bonds, have decreased. So it's not necessarily a winning situation. The price of gold has also increased, with more people buying it due to its relative safety during uncertain economic times. If you're an investor, then these two investment options are available for anyone to invest in via ETFs, or exchange traded funds. Future videos will look at ETFs in more detail, but essentially an ETF is a fund run by an investment company who buys assets, and for this sake we will call the assets bought a cake. You as an individual investor can then buy a share of this ETF or a slice of the cake. You could also look at what are called defensive stocks. During an economic downturn, people still need to live, so companies that provide the basics of living, such as utilities, your electricity, water, gas, food, and healthcare, should still generate revenue. Granted, the sell-off we have seen over the past 2 weeks has touched pretty much every industry, but this is something to bear in mind. So, to conclude, there are many factors as to why coronavirus has had such an impact on financial markets, but one of the main ones is the interconnected world we live in. It has allowed for massive growth, but that also makes it vulnerable to events all around the world. This topic is vast, so there is still lots more to look at. Subscribe to receive the latest videos about world events and the fundamentals of investing and finance.